depending on who you read and who you listen to, and of course, people always think of macro thinkers as doom and gloom. I think it's just being mathematical financial realists. The
Yeah.
question is, there hasn't been a lot of analysis right now on what's happening at the regional banks. As to your point, I don't think the average person right now in line in Brentwood, California at First Republic is there because they looked at an FDIC report on $600 billion in unrealized losses. They're there, to your point, because they're scared. The fear of being burned, right? And they're scared because it's spreading in the headlines, mainstream and offstream and other platforms. It's just a fear. And they've lost a lot of faith. This idea of losing faith is hard to quantify.
Mm-hmm.
I think there's a loss of faith in our government, in our finance, in our central banks, in our parties. So all of this kind of is gelling at the same time, and we're having this headline to exacerbate or add gasoline to that fire. But I think the psychological thing is the most important fear. There are some who think you're going to need trillions to back out these, to support these regional banks. And again, when you see fear spread, it's very hard to know under each balance sheet. We haven't done a lot of analysis yet. I haven't seen good analysis of all the regional banks' balance sheets. But when you see the Federal Home Loan, banks selling treasuries at a discount just to make their clients confident, I think that actually creates more fear. Why are you selling treasuries if everything's fine? Why are you worried about liquidity if you're fine, if your balance sheets are fine? And even at Credit Suisse, which is not part of the headlines right now, before SVP imploded and before Silvergate went into liquidation and before, these other banks are now making the headlines, Credit Suisse was already gasping for air here in Switzerland, gasping for air. They wouldn't even show their cash flow statements. And their stock was down 60% last week. So it's a zombie bank. And I think when you have those headlines at Credit Suisse, you have the memory of Bear Stearns and you have the memory of TARP and you have the memory of bailing out bad banks. And now you see Sam Bankman-Fried ripple effects in Northern California affecting these banks. There's just a real what the hell kind of attitude. What's really going on? And again, will 25 billion or 38 billion or 500 billion or 800 billion or 1 trillion restore confidence? If it does, it will be at the expense of the Treasury and the US dollar. So again, we're in a situation where the average investor probably isn't thinking larger macro themes. They just don't trust. And that's fine. That's a very powerful thing. It's hard to talk about as a pundit to measure and quantify trust. But we can talk about what the long-term ramifications are going to be for the Treasury market and for the US dollar and the invisible tax, which is inflation. Because remember, whatever bank we're looking at, whether it's a major bank like JP Morgan, which has trillions in depositor funds, or SVB, which failed with 170 billion of depositor funds, banks, when the cost of funding their operations is less than the kind of value of the earnings of their assets, they have a problem. And because the Fed has raised rates so high, bond prices have fallen so high, the yields on bonds are higher return than the depositor rate you're going to get in your checking or savings account. So when the yield on a 10-year or a longer term bond is higher than your checking account, why would you want to be a depositor? This then forces banks to enhance their deposit rate so they can compete. But even when they enhance that deposit rate, again, it's still a negative return when you have inflation. So all these forces gel together.
Yeah.
And if banks have to raise their deposit rates, that's going to affect their balance sheets. That's going to affect their margins. And then they're going to have to issue more shares, which dilutes their shares. So it's a vicious circle, all coming back to rising rates, an artificial policy pursued by Powell some time ago to look good in front of inflation, and yet ignore all the consequences in all the markets, including now the banking sector.
Right. Well, as you say, a number of factors have been feeding into this monster, and it's still to be determined just how frightening it'll get. Back to Powell. I mean, we've been saying that the Fed will hike until it breaks something, right? So is this the thing now that the Fed has broken? Is this now what is going to force the Fed to stop raising rates, or at the very least slow down?
Well, the Fed has broken a lot of things already, and this is certainly, I think, the biggest break to make headlines in over 16 to 17 months. I mean, even Goldman Sachs, which was the hawkish bank on Wall Street and so proud to be fighting inflation, which I think was a fiction, but to be fighting inflation and really supporting this QT policy without any regard for the ripple effects and the collateral damage. We already saw the stock and bond markets last year have their worst nominal return, stocks and bonds, correlated since 1871. So that's already pain. We haven't really solved the inflation problem, however it's measured, because it's still a problem. It's still persistent. Remember, Powell was the same one who told us not long ago that this was transitory. Do we really trust Powell? But to your larger question, I mean, even Goldman Sachs now says, I don't expect a rate hike in March 22nd this month. We don't see it. Jeffrey Gundlach, don't even count on it. The question is, will a pause in rate hikes be followed by a pivot to more QE? And already the joke on Wall Street, already in less than 72 hours, this BTFP acronym, which is like TARP 2.0, Wall Street's just calling it by the freaking pivot, because what they're expecting is Powell's going to have no choice now because he has broken something. We'll see if this BTFP program will put enough glue on the egg to fix the broken egg. If it isn't, he's going to not only have to pause in March, he's probably going to have to pivot like he did. We did in 2018. We were raising rates all through 2018. We had that Christmas massacre. 2019, there was a pause. 2020 was unlimited QE. The question is that going to be credible anymore? Can we narrate that from DC to bail out banks at $1 trillion or $2 trillion level again without just creating pitchforks in the streets? No one wants to see bad banks, good banks, questionable banks bailed out again. And the only way to bail them out, of course, is through mouse click money, which is inherently inflationary. So there are so many forces at play here, Michelle.
And it's mouse click money that got us into the situation in the first place.
My strong belief is Powell was never going to beat inflation with rising rates. First of all, even if you assume that the CPI is a legitimate scale, which we all know it isn't, but even if you assume 6.1%, 6.5% CPI is accurate, he's not going to beat that unless he raises rates to 7%, which the markets can't handle. I never believed for a second that Powell was fighting inflation by raising rates. I think he optically, because the Fed is a political instrument, it is not independent, it is part of politics, it's probably more powerful than the White House. But Powell's plan was not to fight inflation. He had to say that. He had to put up a valiant effort. He wanted to be Volcker 2.0. He wanted not to go down as Arthur Burns. But the real issue for Powell was, in the case of another recession, he needs some ammunition, something to lower, something to reduce, or something to pivot when we are really facing the wall, when the blindfold and the cigarettes are on and we're really in trouble. Will he have enough rate hikes that he can reduce in a time of a real crisis? I never thought he was trying to raise rates to fight inflation, because every debt-soaked nation throughout history, pre or post-capitalism, pre or post-democracy, when their back's against the debt wall, they need negative rates. They need inflation to be higher than interest rates. They need to inflate away their debt. And that was Powell's real mission all along. He was never going to beat inflation. Wonderfully, he could misreport inflation, but it was never about inflation to me. I think if we use the Volcker scale of 1980s, we're already at 12 to 13%. We feel that on the streets. We feel that. That invisible tax is hurting us all. It's really hurting the middle class. Even the Fed is now looking to maybe have a target rate of 4%. You have to recognize all the time, this is not conspiracy theory. The CPI scale is disingenuous. It's not even an accurate measure. But I think we certainly can expect more inflation. If we have a recession, that's definitely disinflationary. But the real definition of inflation from Morton Friedman to my business school books is money supply. And though we've been galvanically happy about reporting a 500 billion reduction in M2 money supply, that's so out of context, because we've had a 14 trillion rise in the M2 money supply since the last 15 years, and even reducing the Fed balance sheet by 2% last year. What did that give us? Not much. We didn't really beat inflation, and we caused the markets to crash, to historic levels combined, stock and bond. The risk parity portfolio was a joke last year. So I don't think we've beaten inflation. I don't think our aim is to beat inflation. I think inflation is here to stay. We need inflation in a debased currency, not a relatively strong currency, but a debased inherent currency to beat inflation. So I don't see inflation going away. I see disinflationary forces, but I don't see it going away. I think inflation is necessary to inflate our way out of debt. And I think when it comes down to choosing between the markets and the dollar and the currencies are always the last bubble to bust. We had a subprime crisis, we had a real estate crisis, we had a NASDAQ crisis, we had a tech crisis, stock and bond crisis. The last bubble to burst will be the currency. And when push comes to shove, and when we're in a recession, whether it's officially recognized or not, every nation throughout history has to weaken its currency and reduce rates, because you can't beat a recession with rising rates and a strong dollar. So they're going to have to use this crisis as a pretext to manufacture more mouse click currency, to debase the inherent purchasing power of that currency and inflate away their debt. And of course, blame this on a weird tech reaction, Putin, of course, COVID before, global warming, coal plants, whatever they need. They'll never blame it on the actual patient zero of this whole thing, which was an addiction post-2008 to money on demand that's not tied to an actual service or an actual asset. And it's just debased currency. That's how I see it. That's inflation to me.